where that data is in the offering memo. So I'm going to scroll down here. Okay, and so this is on page 6 of the offering memo. We see the historical cash flow to year 1 pro forma. So the actual for 2011, these values here are what we are going to use as our trailing 12 months data. Okay, and so that, as I said, is going to be on our annual cash flow tab, which I'm going to move over to the right and find. And the good news again is we've already entered this information here in blue as appropriate. Okay, so nothing needs to be done there. I just wanted to direct your attention to the process that you would go through for a new transaction if you were to be loading in a new transaction from scratch. This is sort of the order of operations that we would use. Okay, and so the next section down here is our estimated annual other income and pass-throughs for 2012. I'm going to go ahead and change this to 0%. This is if you want to show a growth from the 2011 actuals. These are, again, the actuals for 2011 from the offering memo. And let's go ahead and scroll down. We have just a breakout here of our annual expenses for 2012 on an estimate for the entire year. Okay, and so what we're seeing here on this assumptions tab is that the composition includes both inputs, which are in blue, and outputs, which are in black. So this is essentially both an inputs tab and a reporting tab back to you as the operator of the model here. Okay. Our next major input is the annual expense growth rate, which we're going to run at 3% for our operating expenses. And then we have our gross rent deductions down here, and the next exercise was to enter the vacancy assumptions given by the broker. And let's just find those quickly and then go ahead and enter them. Okay, so here I am on page 12 of the offering memo, and these are the assumptions. The broker used vacancy loss, and they use 4% for every year of projection. Okay, so what I'm going to do here is I'm just going to put in for vacancy loss residential 4% across the board through year 10. Okay, and that's done. We don't currently have any non-revenue units, so we can leave that at 0. If we want to put in write-offs, we can do that as well. I'm not sure if they had something for write-offs, so let's just take a look. They do have loss to lease here of 0. Okay, so we currently are running 0, so we can leave that as such. They do have rent concessions of 0. We currently have 0 as well. And here's our bad debt expense, which is the write-off. So that's being run at 0 as well by the broker. So everything is all set in those terms for now. We can naturally always go back and then make adjustments based off our opinions. But for now, let's go ahead and scroll to the top right of the Assumptions tab to the Rent Growth and Renovation Schedule portion. Okay, and this really is going to be, as I said, where the action in the model occurs. And so we can now proceed with entering in the growth rates for the rents that are given by the broker, and we'll reference the memo for that. Okay, so the rent growth, so we had again on page 12 of the memo is 3.4, 4.7, 4.7, 3.4. Okay. and then 3.3, 2.7, and then going forward, year 6 and forward, it's 3%. Okay, so we go ahead and enter those in, and this is what the assumed rent growth schedule is going to be for the next 10 years. Okay, and so now what we need to do is figure out, okay, of the 30 units here, how many do we expect to renovate in each year? So this represents year 1. Here's our cost, which we had input as $7,500. And so what we've done here is we've put 10 renovations in year 1, 15 in year 2, and 5 in year 3, which equals our 30. And that is what we're saying, at least at this point in the analysis, at this point in our modeling of the transaction, that we feel we will be able to access those units in those years. Okay, and so as a result of that, naturally, we are going to model in some rent growth premium, and this we have done here in cell P8. This is the $100 assumption that the broker had put forth, and this is naturally something that we can modify. And so for an average rent prior to renovation of $808 per unit per month, we're now showing an average of $900 post renovation. Okay, and so this is what we are saying is the story, okay, for the value creation process as it is going to be executed. Okay, and again, we can always go back and modify, and we likely will go back and modify these things a little bit. The next section down is our acquisition, financing, and disposition. We are simply carrying a purchase price in cell P29 of $2.8 million, which is the price, the asking price. We're probably going to bid something lower than the asking price, but let's just start the analysis using the asking price. And then we have closing cost assumptions, and then fees, and so on and so forth, which is going to give us a total leveraged uses or total acquisition cost of $2.894 million. Okay, and so if we scroll across here and say, well, what is that purchase cap rate? Okay, just using the purchase price and the current NOI, that is going to be a 6.75 cap. Okay, so this is close to what the broker said it was, which was a 7 cap. So there's some slight differences here which we can later figure out. So for the acquisition loan, we have an assumption for what we feel that we would be able to achieve. This was given to us by the broker, 70% at 5.45. It's going to be a 10-year loan with a 30-year amortization period. This would be our monthly payment for that, the annual payment there. And this will tell us that on a residual basis, the equity or cash that we need to invest to consummate the transaction would be this $875,537. Okay? The broker did not model in anything relative to a refinancing, but why don't we say if we're going to finish our renovations within the span of 36 months, that we will refi as of the end of year 4, giving ourselves some cushion. So we enter in month 48 here for the refinancing timing and assume the following values, and so we will see in our model in the monthly and the annual cash flow how the one loan replaces the other. Okay, and so this is sort of the beginning of the analysis from an overall point of view. The next thing that we're going to do is move into the cash flow tab and really come to understand what the schedule of renovations will be, not just on an annual basis but on a monthly basis. Okay, so before we get to the cash flow overview, just wanted to show you we do also have a tab in here which shows the renovation schedule here, which is a reflection of what's happening on the monthly cash flow tab. On the margin, I say it's always good to graph these types of things, especially if it's the driver behind your strategy, is to make sure that you are reflecting something that's reasonable. Okay.